Hello, my name is Alan, and welcome to All About Stocks. And today we're going to talk about savings and why it's important to save. And the reason it's important to save is sometimes the market can be very volatile. And let's use AG&C as an example. Let's say the market jumps around just a little bit. Currently, let's say AG&C is trading at 1660, which I think is very current for their price. And you have, let's say 20 shares at 1660, which makes your initial investment at $332. Well, let's say that the price drops to $14. Well, that's going to drop your price down to $280 that you have with AG&C. Now, if you go ahead and cash out with AG&C, and that's all the money you have with AG&C, now you lose that money, your $360. So you basically just lost $80. Now, if you have the savings, then you don't have to cash out with AG&C. Now, what you really want to do is try to go ahead and save up about 3 to 6 months of salary. Now, I'm not saying that you don't want to just focus on saving 3 to 6 months of your salary and then start to invest. I would focus on saving while slowly investing, and then once you get 3 to 6 months saved up, then start to do your initial investing after that. Once you get your initial 3 to 6 months salary saved up, that's when you should start to accumulate your 10 to 15% or even more if you can afford it. That's when you could do your initial or your whatever you feel comfortable with investments, because everything can be very volatile. And you can do ETFs, which ETFs or mutual funds, those are not as volatile as just stocks. Now, I wanted to also go into each age bracket and what else, what your goals for retirement should be. Now, I wanted to break that down where you're going to aim for, because just telling you, hey, the stock market's volatile and you should save, yeah, most people are going to know that. But saying, hey, let's use 20 years old or in your 20s. If you can, most people don't make very much in their 20s, but if you can try to save, let's say, about $7,500 a year throughout your 20s, it's going to put you on pace to accumulate around about $1 million if you continue to do that, plus your 10 to 15% throughout your life. You'll probably be around $1 million by the time you go for retirement. Now, if you continue when you hit your 30s, then you continue to add with your pay increases. Then you want to increase with your pay increases. So let's say you get a $10 raise, then with your $10 raise, add $1 with your investments. Don't just go, hey, I got a $10 raise, so I'm going to go splurge with my raise. No, you want to add that extra 10% with your investments. And if you can afford it or you want to, go ahead and put more into your investments. Now, I've always thought that, hey, if you got a raise and you're doing good without the raise, then you should go ahead and put all of your raise into the investments. You are doing fine without it, so you might as well use it all towards the investment. Unless you're hurting without the without the raise, then you might need to go ahead and use the raise elsewhere. But do what you need to do. But when you can set aside that money, set aside that money. Now, I'm going to go ahead and talk about retirement, and I'm going to talk about what to expect for your 40s, your 50s, and your 60s in my next video, so please stay tuned for that. I hope y'all are having a great day, and stay tuned. And thank you for seeing me at All About Stocks.